In this video, I'm going to walk you through 6 different options trading strategies that can make you as much as $100 a day, if not 200, maybe even 300. If you see here on my broker, over the last 30 days, I've made roughly $6,800, which equates to about $229 per day that I made using these exact strategies. And again, I've also helped over 600 other traders do this and generate a verified profit of over $600,000 for all their accounts combined. So let's dive in to this video, which is going to break down each strategy. So here's the first one. We're going to go over what the strategy is, an explanation of it, the back test, and how to trade it for every single strategy. So let's dive into the first one. The first one is a Strangle trade is pretty easy to understand. Let's pretend like this is a stock. So the stock is trading here. We're betting that the stock will stay between two levels. We're betting that it'll stay above this bottom level and below this top level. If it does, we make money. This is what a Strangle trade is. It's super easy. So if we're looking at the back test here, you can see this. Again, I'll try to link the back test down below if I can. But you can see here a 98% win rate on this trade, an average winner about $800, an average loser about $7,000. Again, there's a ton of great ways to manage risk, which I get into in other videos on my channels. But this is still a great and consistent strategy when you're using it in the best markets for it. So now you might be asking, okay, this is a strategy. What is the best markets? You're going to be looking at the best markets of slow bullish strategies. So this means we're slowly moving higher. Sideways strategies means that we're staying in between a support and resistance, obviously, because we want to play the range. And then also a slow downtrend as well. So a slow bear market. So either one of those markets is how it's going to work best. And so how I personally trade the strategy is based on this back test, which is going to be a 120 DTE trade. So I go out 120 days in the future. What I do is I do a 10 delta put for my selection, and I do a 5 delta call. This skews it a bit higher because in general, the market moves higher. So these are the best ones. I manage it at a 25% take profit, and I close the trade at a 300% stop loss. This means if I make a 25% return on the trade, close it. If I make a 300% loss, close the trade out as there. And then again, there's other ways to manage risk, but I cover that in other videos. This is just for the strategies. That is the first one, the Strangle strategy. This is what it is. This is the best markets, and this is how to trade the exact rules for the strategy. All right, cool. For the next strategy that we're looking at is a calendar spread strategy. So if we look at the back test, you can see here, this is the 3-4 calendar spread, which again has been very consistent over the last couple of years. And so basically we're doing a put debit spread trade. And how we're doing this is we're offsetting it by a calendar. So there's different expiration dates. So you can see here, we're going to sell the put at the 3 DTE mark, and then we're going to buy the put at the 4 DTE mark, and then we're going to take profit at 15%. So what exactly does this trade look like? It looks like this. It's a put debit spread. So that means it's going to make money as the market goes down. And so again, in general, the market tends to have some down periods every once and a while. And so again, if we can capitalize on that, that's nice. But again, this works best in bearish markets as well as sideways markets, because we get to capitalize on the theta decay that happens on the short side. So this is what we're looking at. Again, we have a 3 DTE for the put that we're selling, and we have a 4 DTE for the put that we're buying. And so again, we're going to sell, I'm going to do -1 put, and then actually we're going to sell this put, and then we're going to buy this put, and they're both going to be at the same strike price. So for instance, if SPY is currently trading at $5,000, and that means we're going to sell the put at $5,000 at the 3 DTE level, and then we're going to buy the put at $5,000 at the 4 DTE. Now, because of the expiration dates on this, we can only do this trade on Monday and Monday plus Friday, because there is no 3 and 4 expiration on any other times except for Monday and Friday. So those are going to be the best times to run that. And then again, we have a 15% take profit that we just let the trade hit. And if not, we just let the trade run through. So we have a set loss amount, and we have a tight take profit, which then leads to a very consistent 91% win rate. And again, that's awesome, because in this trade, you're only in it for about a day, which is great. You're in a trade for about a day, and you're able to make about $100 per trade. This is a very great one that I've seen a lot of my members using my automation software, which automates over 5,000 trades a day. A lot of members use this to make good money. Now, what is the next strategy that I've seen a lot of people make money with and have made money with myself? That is the 1-1-1 strategy. Well, the 1-1-1 is essentially, it's a bullish strategy. So let's say the market is going higher. where you're betting that the market stays above a certain level. So essentially it's a put selling strategy. But if the market goes down, you have a little hedge zone where you make more money. So if the market goes up, you make money. If the market goes sideways, you make money, about a 1x payout. If the market slowly drifts into this range, you get to make a 2x payout. And the market breaks this level, that's where you start losing. And so that's what a 111 is basically a short put, but a hedge built in. And so this again works best for bullish markets and sideways markets because there's no cap on the upside. So that's why it's a bullish market strategy, but also theta decay, it takes effect in sideways markets. So that helps. So this trade is a longer term trade. And so what I mean by that is we're going out. And by that, I mean we are going out to the 90 to 120 DTE mark trade because we go out further. It allows us to collect more profit, collect more money, and increase our win rate. And then what we do with this is we're going to buy a put at the 25 delta level. We're going to sell a put at the 23 delta level. And then we're going to sell another put at the 10 delta level. So this put is creating our income. These puts are creating our downside hedge that makes more profit if the market drops. And basically we're looking at this strategy right here, a 111. You can see here 25, 23, 10 delta, 120, 120, 120. We do a 50% take profit and we close the trade early at 21 days. And you can see here, very consistent 83% win rate. And one of my favorite things about this strategy and why I use it as well is because we have roughly the same amount of winners and losers. So our win amount is about 1,100 and our loss about 1,500. So they're roughly the same. So when I lose, it's only going to take out 1.5, maybe one of my winners, which is awesome. I don't want one loser taking out a ton. And so with an 83% win rate, this tends to be a very good bot, especially when you stay in those uptrending and sideways markets. That's a 111 trading strategy with that. Again, 50% take profit on that, and you're going to close the trade early at 21 days. This means that once you've been in the trade, so let's say you enter at 120 days, once 100 days have passed, so there's 21 days or less left until it expires, you'll close out that trade. So that is the 111 trade in the back test as well. If we dive into strategy number 4 is the Iron Condor calendar. So if we look into the details of this is actually very interesting. You can see here over the last couple years has been fairly consistent on the slower side, but something to look out to is that you will have larger losses on this type of strategy. But essentially what you're doing is you're doing you're doing a condor, but the ones that you're buying, like the options that you're buying, are going to be further out in time. So you're doing a 3 DTE, you're selling that put, and then you're selling the call at 3 DTE as well. But then you're going to buy the 7 DTE put. So you're doing an Iron Condor structure, but the ones that you're buying are further out. And this kind of creates more of a debit spread structure. You're able to actually buy and have a set risk, but at the same time, you're also allowing it to collect the theta decay of the short options as well. And again, there is really no take profit or stop loss on this trade. So please be aware that you can see great wins as well as great losses. But again, this is a weekend income bot that I've seen people make a lot of good money with, plus you're only on the trade for 3 days. Now, I would recommend this for larger accounts only. Do your research on it, paper trade this first, but that is the Iron Condor. It's hard to sketch out exactly what the profit graph looks like on that, but that's the Iron Condor calendar. Next is the 112 strategy. This is very similar to the 111. And let's say the market is trending here. It's the same type of trade as the 111. We're betting that the stock is above a certain level. If it does come down, we have a hedge where up here we'll make 1x of profit. Here we'll make 2x. But instead of selling one put here, we're selling 2 puts. So we're buying a put. Again, all these things are the same except for the bottom one. So we're buying a put at the 25 delta level. We're selling a put at the 23 delta level. And then we're selling 2 puts at the 7 delta level. So we go further out, but overall we're collecting more credit because we have 2 of these. So this has an average win amount of about 1,000, depending on how you trade it. This will have an average win amount of about $2,000. Again, you're just collecting more money, but with that, you're also adding more risk. So this is why it's further down on the list, because there's more risk to this trade. But overall, same structure. It's going to give you a good return. If we look at the exact numbers here, you'll see that it does well, but it does drop off with the risk a lot. Like I mentioned, you have a lot more risk for this strategy. You're also in this trade a lot longer. So you're in this trade about 60 days, and that's how you're running this 112 body. And you can see 25 delta, 23 delta, 7 delta is how this trade is being structured. Last but not least is probably what a lot of you guys are using, which is the 0 DTE Iron Condor. So this one's a very popular trade amongst our users. Basically, the trade trading here, we're basically betting that it stays between two levels, but we also buy options to define our risk. And so the way that we do this is quite simple. Okay, when there's 2 hours left before the market closes, we then enter this Iron Condor. That's plus or minus $20. Okay, so that means if, just for easy numbers, the SPX is trading at $100, that means that we're going to do a call credit spread at the 120 mark, and we're going to do a put credit spread at the $80 mark. So $20 from here, $20 from here, giving us a $40 wide level. We also, to avoid PDT risk, because I know a lot of people who do the 0 DTE Iron Condors don't have enough money to get past the PDT rule, which means you can only make so many trades in a certain amount of period. What we do is we just let the trade expire. So what we do is we just let the trade expire in the money or expire out. So either we make money or we don't make money. Either way, when the trade expires, it doesn't count as a PDT rule against us, allowing us to do the 0 DTE trade every single day. And so again, we do plus or minus 20, and then we do plus or minus $5. So we're creating a $5 with credit spread for each side. That's how it's run. Then we let that trade expire. And so we look at the back test of this. You can see here, up and down, depends on what you're doing. Obviously, you'll have better results if you avoid FOMC days, avoid market news days, and things like that. You'll be able to increase your win rate. You can also increase your win rate by making sure that you only collect a certain amount of credit. But you can see here, plus or minus 20, depending on if it's a put or call. Then we go a $5 wide difference. I have about an 84% win rate. We'll make about $70 to $100 per trade, and we'll lose about $300 per trade. And so anyways, all these strategies combined are a way to generate at least $100 per day, again, depending on your account size and your risk. But again, they're put in my favorite order: Strangles, 111, 112s. These are great. You have the calendar spreads for defined risks, the Iron Condor, and the Iron Condor for defined risks as well. Anyways, these are the 6-pack strategies. If you learned something, please smash that subscribe video, and I'll see you in the next one.